All right, guys. So 2 hours till non-farm payrolls. A big data release. You know, typically, as most of you all know, it's one of the big events each month. I think it's probably lost some of its grandeur as a result of yesterday's extraordinary events in Frankfurt and the ECB. And you know, you can look at my charts here that I'm sharing. You know, massive scale movement. So I think this data release here, coming this afternoon from the US, probably not quite as significant maybe as perhaps it has been. And also because we're so close to the Fed meeting now in 2 weeks' time, you know, really does this figure right here today, does it carry significance to what the Fed's decision is going to be in 2 weeks? That's really the big thing here. Will the Fed change their mind if, you know, based on this number this afternoon? And the answer to that is almost certainly not. You know, and I think that's the main thing to say. Most likely, the Fed have already decided they're ready to commit to hiking rates, and it's unlikely today's figure is going to change that. So again, that's why this figure probably is reduced in importance and significance compared to how important it's been in recent times. And before we go any further, let's review last month. Now, a few things to show you. Let's go through a few of the pictures, the charts of the most important numbers here, because don't forget this is the labour market report. Not just the non-farm payrolls number for November, it's the labour market report. We get lots of info about the labour market from different angles. The non-farm payrolls number, the number of jobs created, obviously is the headline figure that grabs the immediate attention, but we also have things like the unemployment rate being announced, which, as I'll explain in a minute, is pretty irrelevant. But one that is not irrelevant is the average hourly earnings number showing showing wage growth. Okay, but this chart here is non-farm payrolls, and massive number last time out. So this data was announced on the 6th of November. It showed that in October we had the fastest rate of job creation for the whole year. You've got to go back to December 2014 to get a higher number. Okay, this was a big number because we'd had 2 bad months in a row, as you can see. August and September, if you take the 2 months combined, that's the worst back-to-back payrolls months since 2012. And it was like, wow, is this the beginnings of a loss of momentum in the US labor market, a loss of momentum for the US economy? If it is, well, the Fed, there's no way they can hike in December. And we went into this figure on the November the 6th and thinking if we have a third reading below 150 and a third bad reading in a row, we'll then forget rate hikes. They're going to be pushed right out into the middle of 2016 at the earliest. This is what we were fearing going into the figure last month. Of course, it came out and it couldn't have been more different to what our fears were. It was, not only was it not bad, it was phenomenally good. Best for the whole year, and it was like, wow, right. It was a relief, really. The labour market has not lost momentum. The labour market is nice and solid, and it was the green light, right? The Fed are hiking, and the probabilities for a December hike changed dramatically 1 month ago. We were pricing in about a 30% chance of a hike before this data. After this data, it jumped to like 60, 70%. This one figure was huge last month. I'm going to bring in a couple of charts here. Firstly, here's euro dollar. This is the reaction to non-farm payrolls 1 month ago. We've just had a monster day yesterday because of the ECB, where we actually saw a 500 pip range. This is almost as spectacular, but not. This right here was, well, we were trading up around the 108.80s and we finished up bottoming out 107.11. So we had a 170 pip move off this payrolls number last month. Huge dollar strength as we saw a dramatic increase in the expectation of the Fed hiking rates on December the 16th. How did the S&P behave? Well, actually, no, let's talk about T-notes first, which is more straightforward. Here's the T-notes reaction. And you've got to think about this when we get today's figures. How are these different assets going to behave? This is T-notes. So for the dollar and for T-notes, it was very, 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 very straightforward. One, a unidirectional, no-brainer. The Fed are hiking, the dollar appreciated, bond yields rose, so bond prices dropped. It doesn't get much easier than this. However, trying to trade equities was a bit of a nightmare, it has to be said, because of that conflict. On the one hand, it was phenomenal news for the economy, a real relief that economic growth was still there. We were panicking and for no reason. And then so it was relief. But then at the same time, so that's good news for equities. The economy is in better shape than we thought. But of course, if the Fed hike, well, that's bad news for equities. And so we got a lot of chaos. This is on a 5-minute chart. I mean, the range in the first 5 minutes was 17 points, but we moved higher and low. We actually firstly made a new high for the day. Then we reversed and made a massive new low. We chopped around a bit. Then between 2:10 and into the US Open, we almost rallied back to the high, not quite. Then we turned and flipped and drove and made a new low, and you can see it was a real violent, chaotic reaction. By the time we got to 7 p.m., we were basically back to where we started. So just to stress, trying to trade equities or payrolls is probably not a great idea because of this conflict you have between the economic argument and the monetary policy argument that are conflicting. So if you can, stick to the dollar, stick to T-notes. It's a bit more straightforward. So that's what happened last month in terms of market reaction. Let's just go back to the charts and just take a look at the other figures that got released last month. So the unemployment rate dropped to a new post-crisis low, 5%. And if I just show you this on a longer time, but let's go to a 10-year chart. We're right back to pre-crisis levels here. There's a chance this might drop to 4.9% and continue this trend. There's probably a higher chance it might go back up to 5.1%, by the way. They obviously round up, they round the unemployment rate number to 1 decimal place. So it's 5.0%. The actual more accurate reading was 5.036% for October. There is a chance it might just edge a little higher and go above 5.05, which means it'll get rounded up to 5.1 rather than being rounded down to 5.0. Basically, it doesn't matter. I would say pretty much ignore the unemployment number. It's absolutely fine. 5%, it's more than good enough for the Fed to hike. You're not going to get much of a change on this, and even if you do, it's kind of not relevant. All right, so I'd ignore this. More important is the average hourly earnings. This is what happened last month. Month on month, we got a plus 0.4% reading. Okay, we've seen this improve. I don't have a chart for the annualized reading, but the annualized average hourly earnings number increased to 2.5%, which was a multi-year high. Okay, so again, this is really a strong signal that wage growth's coming, beginning to build, and this is what the Fed are waiting for to then make the judgment that core inflation is going to rise. So wage growth is key to the Fed's inflation outlook, and it's that inflation outlook that at this stage in the game is the most important measure that the Fed are using when they're trying to time their rate hike, plus also trying to judge the speed of the hiking cycle. The labor market's recovered, so it's all about inflation. And this is the element of the labor market report that gives you an insight into future inflation. Okay, so this is going to be an important number today. But this certainly helped last month to drive that radical move on the euro dollar, radical move on T-notes. This, along with the huge payrolls number, this data also contributed to substantially increasing the probability of the Fed hiking rates. So let's have a look at the numbers on my data calendar here. The first thing to note, there's a huge amount of numbers. Look at this, all the ones I've highlighted. these are all being dumped on us at 130 in one big hit. It's difficult to trade this because there's so many numbers, they can often be conflicting. And so you can often get, the market reacting to each number individually, and you can get good news and bad news. It can create volatility. Okay, so just bear that in mind. In order of importance, well, it's payrolls that's first important, okay? And we're expecting 200,000. That's the market expectation, 200,000. That's number one thing on the list of importance. What I would say number two is it could well be the potential revision to October's number because it was so extreme. We want to see if it was real, if it was valid. Is it going to get revised? Most people will think, well, because it's so high, the natural thing is to think, well, it's got to be revised down, right? That's not necessarily the case. In the past, like in the last year, we had big payrolls numbers that then ended up getting revised up the following month. So it is possible to get an upward revision. But keep an eye out for revisions to last month's figure, and indeed the figure the month before that, which was really bad. Let me just remind you, on this chart, is the last 2 months could get revised. And the last 2 months couldn't have been more opposite. October, huge reading. September, really low reading. Both of these could get revised today. So that's number 2 importance. Number 3 importance is definitely average hourly earnings, in my view. What we're expecting is a drop from last month's nice and solid reading. So we're expecting a drop but still positive, plus 0.2%. On the annualized basis, we're expecting a drop from last month's 2.5%, which was the multi-year high. We're looking for a little pullback to 2.3%. Okay, these are the key numbers. Let's take a look at the charts. Where can these markets move to on different scenarios, and what's the kind of thinking when you're trying to kind of bring in the Fed into this, and how they might interpret this news? So first of all, look at equities, and this is the hardest one to get right. What's my opinion and what's other people's opinions? Well, so as I said, the median and market consensus is 200,000. The highest, the most bullish financial company out there is South Bay, who have got a prediction of 267,000. These are of the people who submit to Bloomberg. South Bay are the most bullish. Deutsche Bank are the most bearish at 150,000. Thinking about, it's such a hard number to predict. It's almost impossible. But if you were going to try and judge whether this number is going to beat or miss expectation, then there's arguments that it could be stronger, and there's arguments it could be weaker. If you want to argue that it's going to be a strong number above 200,000, then some of the information over the last week that you might be most interested in would be things like the ADP employment number. That came in above expectation at 217,000. That was on Wednesday. You could look at the manufacturing ISM survey, which was released earlier in the week, and that saw an improvement so this is the employment component of ISM manufacturing. It went up 3.7 points. It went up to 51.3. But that was, I would add a caveat, that was moving from a very low reading the month before. So it went below 50 the month before. And just bear in mind, so that's in October, the ISM manufacturing employment component dropped sharply below 50. And how was that as a guide for payrolls? It was a very bad guide, because the payrolls number then got announced the strongest for the entire year. So if you're trying to now use the manufacturing ISM employment component as a lead indicator for this data today, I think you've got a short memory. The other manufacturing numbers, like the Philly Fed number, the Empire State, the Dallas Fed number, all these had manufacturing components that improved. Okay, So these are things that you could look at to say, well, look, we're in for a good number here. Other things, stuff like online job ads. So the Conference Board's Help Wanted online report showed that solid gains in November for both the new and total online job ads. Okay, things like job cuts, the Challenger job cuts number showed a decline in job cuts in November to the bottom end of the post-recession range. So all these are very positive things that you could use to say this is going to be a strong number. You've then got opposite arguments, of course. The ISM non-manufacturing number released yesterday, the employment component was really bad. It dropped 4.2 points down to 55. The jobless claims 4-week moving average has edged higher by hardly anything, though. It's 8,000 higher than it was on payrolls last time out. So it's not really a big change. The other thing to note, and this is why Deutsche Bank is so bearish, and I think it's quite an interesting bit of analysis. They're pointing towards the fact that October, where the figure was 271,000, they're saying that that was because retailers went through seasonal hiring early this year and made significant hires in October at the expense of November. And what they're saying is retailers hired in October, and if you look at retail sales data in the US, it backs it up. The retail sales data for October was really strong. And retailers went through a large amount of hiring, which is why the payrolls number in October was 270,000. Deutsche Bank is saying this is going to be now to the detriment of November hiring. So Deutsche Bank think the figure is going to be 150,000 as we get a seesaw swing. And actually, this is just the point to make. We have seen volatility in payrolls substantially increase in the last sort of 3-4 months. So are we going to see the volatility continue? So a really low number in September, a really high number in October. Are we going to get a really low number in November and a really high number in December? You know, have we got into this volatility cycle? This is something to think. For what it's worth, and it's a complete random guess, really, when you're trying to predict the payrolls number. For what it's worth, I think it'll be disappointing. I think it'll be below 200,000. I think it might even be below 150. But that's just, you know, there's no way of knowing whether I'm going to be anywhere near right. It's more of just a punt. For what it's worth, Amplify traders, our survey, Amplify trading has a mean expectation of 205,000. We have a low ball, the most bearish in the group of Amplify traders was somebody called Piers, Curran, who predicted 137,000. I'm anxious. I'm at the low end of the range. Anyway, we have somebody at the high end of the range, and it's not just any old body. It's someone called Joseph, who's gone with a 326,000. Now you may laugh, but this time last month, Joseph predicted 290,000. He was a massive outlier, and he won. He was the closest. So he's got a history. He's got precedent here. So Joseph up at the top of the list, 326,000. Okay, that's the Amplify prediction. Let's just quickly talk about market reaction, and then we'll leave it there, and we'll build into the number, which is due in about an hour and a half. So yeah, let's talk about equities quickly. Look, I think a hike, right? Thinking about the monetary policy angle, a hike's priced in. I think what's more important here when you're thinking about the Fed is this data helps us judge what the pace of the hiking cycle is going to be. It's not really about are the Fed going to hike or not. I think they really have committed and they're going to hike. So I think it's more about, well, when will hike number 2 be? At the moment, markets expect the second Fed rate hike to be in June of next year. This data today might change our expectation on that. If it's really strong, then you're going to see that second rate hike being brought forwards to, let's say, March. That's going to be bad news for the S&P, I think. So a really strong number, and you may well see, like we got last month, although it was choppy, you may well see the S&P move down because we price in a faster rate hiking cycle. So I'd say anything above 250, and you're probably going to get a negative reaction in the S&P. What about if it's lower? Anything between 200 and down to, let's say, 150, then it's kind of the worst of both worlds, because I think that's not bad enough for the Fed to change their mind. So you're still going to get the rate hike, but also it's bad data. So it's like a double negative. So I think also the S&P sells off. I think the only way the S&P can rally here, well, I think the only way it can rally is if this number's so bad that the Fed don't hike. But it's got to be, I don't know, it's hard to judge, but maybe it's got to be below 100 to really get the Fed sitting up and saying, wow, hang on a minute. But then the worse it gets, then the more extreme it becomes, the less believable it is, and the more likely it's due to some kind of one-off freak anomaly. So, look, I think it's going to be hard for the S&P to rally off this. I really do. But it's not going to be straightforward. I think it's going to be much easier for the dollar. I think the easy trade here, the easy big trade, is really strong news, dollar strength. Okay, because we had so much dollar weakness yesterday. Look how much distance we've got on the way back here. The biggest move, without a doubt, will be dollar strength off a really strong payrolls number that sees us begin to price in a steeper rate hiking trajectory. We could get back to 107, 106. We got a 200 pip move last month. We could get another 200 pip move this month. So maybe 107 if it's 250 plus, you know. If it's really bad news, well, then I'm sorry, but we have to move higher. You know, I think we begin pricing in the idea that maybe the Fed are going to hike once and maybe that'll be it. Or they're going to hike once and the second hike will be in the summer next year, in which case that's license for this thing to break 110. And I showed you on the weekly chart in the briefing this morning. Be aware that we're only mid-range here. At 110, we are mid-range. So, you know, we can move, there's plenty of room to move higher, even though we had such a massive move yesterday. We can still move a lot higher today, breaking above 110, if this data is really bad. Anything around 175 to 225, then that's a tricky one, I'd say. I think you're probably going to see, it'll be a difficult trade. I don't think you'll get movement, but I don't think it'll be consistent. On T-notes, well, it's kind of similar. You know, if you get a really, really, really strong number, well, then we're going to price in a steeper rate hiking trajectory, which means this is bad news for T-notes, of course. Bad news for bond prices as they sell off to price that in. So you're going to get a correlation between T-notes and the euro dollar. One thing to kind of finish on, be careful. There's plenty of numbers here. More often than not, you get a confliction in that there's good news, good elements to the report, and then there's bad elements. Don't forget about the revisions to previous data. Don't forget about the wage growth numbers. It's not just about job creation anymore. It's about inflation expectations, and that's why the wage growth numbers are important. If the wage growth number comes in at 0 or even negative, well, that's really bad. That's something else the Fed might have to sit up and say, wow, okay, that's made our decision in 2 weeks more difficult. Or it could go the other way. If wage growth, if average hourly earnings comes in at +4 or even +5%, +0.4 or +0.5%, well, then you're going to get the pricing in of a steeper rate hiking trajectory. Okay. Final point, algos will be all over this. So you're going to get a lot of instant, sharp reaction. There's nothing wrong with just sitting out and waiting, just digesting all the numbers, making sure there aren't any obvious conflictions. before then making a judgment, right, I do want to trade, and thinking about your entry point. All right, so there's nothing wrong with just sitting back and let the kind of algo driven chaos subside before getting involved. All right.